So protective put strategy, also known as a married put, is designed to safeguard your stock or your portfolio against a decline either in the underlying asset or in the marketplace, right? So when you think about owning a put or buying a put, right, it is analogous to actually buying insurance. So that's kind of the dynamics that you're looking at. And we're going to go into how when you go out and you purchase insurance, what that looks like, right? You're looking at the longevity of that particular policy, or how much am I going to pay for that policy? How much protection do I have in that policy? These are the same kind of decisions that we'll be reviewing, and if you're trading a protective put, that you would be deciding on. So a protective put is designed to limit your downside exposure, right? You still have all that potential upside, profits that you can make, but you got to add on to that whatever you paid for the option, but you still have that upside potential there. This is typically, I think, individuals that use the protective put, they're just concerned. There might be information out there. You still have a bullish outlook. You're happy with owning the stock, but you know what? Maybe it's time to buy some protection because there's a lot of noise out in the marketplace about your stock. So what is important about buying that put is strike price selection, right? Strike price selection determines what that protection looks like. When you're choosing strike price, that is where you're looking at how much risk are you willing to take for that protection, and where do you want that protection to kick in, right? And for those of you that are actually holding a position that's a stock position that's profitable, you can use buying a put to hold on to some of those profits, right? And again, you're going to select a strike that optimizes the downside or optimizes your profits and then limits that downside risk as well. So when selecting a strike price for the protective put, it's a balance between your risk tolerance, your outlook, and your investment goals. Those are the three things that you are managing when you're going to select that strike. Now, the higher the strike, the more protection you have. But the more you're going to have to pay for that protection. On the other hand, the lower strike, the option is cheaper, but you don't have the same kind of protection. You're going to have a little bit less protection. So the strike price offers you a way to forecast what your potential loss could be. So let's just look at this example right here. If I own stock at 100, and let's say I am like not hearing good things, I want 100% of my risk. I want to eliminate all my downside risk. And the way I'm going to do that is I'm just going to buy that 100 strike option, right? I'm going to buy that 100 strike option. It kicks in as soon as it goes below 100, and I've got protection. My only risk is what I paid for that put, right? So on the upside, I still have all my upside, but my new effective price, right, I needed to go above the premium that I paid for that option. So when I'm looking at, we'll look at the 100 strike, right? I have my bid and my ask.